Hello and welcome to this webinar presented in partnership with Bloomberg. I'm Neil Stewart, Editorial Director of IR Magazine. This is going to be a very quick 30-minute briefing covering quite a lot of ground, maybe maximum 40 minutes depending on questions from the audience. But we're looking here at IR for the financial sector, and we're looking at it from two sides. First, through the eyes of investment professionals. Every year for the IR Magazine Awards, we interview investors and analysts around the world asking which companies do the best IR and why. Second, the view from inside companies. For our global IR practice surveys, we've interviewed thousands of companies about how they do IR. So our soon-to-be released financial sector report, we're planning to put it out tomorrow, it has slices of all that data for the financial sector. And that includes banks, investment managers, credit card companies, insurance companies, as well as real estate, although in our Greater China and Southeast research, real estate is broken out separately, so generally excluded. We have registrants for this webinar from around the world. It's pretty fascinating to see who's logging on. IROs from companies across different sectors, not just financial sector, consultants and service providers. We have people calling from Australia, Brazil, Canada, right across Europe. We have people from Hong Kong, India, Japan, South Africa, Mexico, Singapore, and so on. It's a pretty amazing list of registrants. Joining me today, giving us her perspective as an analyst, Allison Williams, Senior Analyst for Financials with Bloomberg Intelligence. Allison specializes in global investment banks and asset managers, as well as North American banks and specialty finance. Before Bloomberg Intelligence, Allison was a portfolio manager and analyst for Morgan Stanley Investment Management, where she managed a financial service investment fund and co-managed a diversified multi-capitalization fund group. Before that, she spent several years in equity research covering financial services at UBS, Warburg, Payne, Weber. Now, Allison, most of our listeners are very familiar with the Bloomberg Professional Service, and we know Bloomberg News, but Bloomberg Intelligence is new for a lot of us. Briefly, what is it, and how is a Bloomberg Intelligence analyst different from a traditional sell-side analyst?
Good morning or afternoon, depending on your time zone. So Bloomberg Intelligence is a relatively new research service within Bloomberg, and we focus on providing proprietary data and analysis across a number of sectors, essentially worldwide. And what's different about our effort is that we don't make stock recommendations, so that's helpful in the sense that it helps us to avoid a bias in terms of just providing objective, clear analytical views.
So while an analyst might be a bull or a bear or a certain stock, you give both the bull and bear scenarios. Is that right?
Correct.
Okay.
And really, a lot of our effort has to date focused on providing sort of the industry context, and the relatively newer part of our research is that we've started providing company primers across, we're I think at 1,000 companies right now, and further building that effort.
Okay, great, thanks. So listen, before we hear from you, Allison, I want to give some highlights from our upcoming research report on the financial sector. So in Europe, Canada, the U.S., and Southeast Asia, in recent years, the top financial companies have also ranked top in IR across the region, or near the top. In the U.S., J.P. Morgan Chase and American Express, the two top in the financial sector in the U.S., are also in the top 20 overall. Allianz in Europe has been a Grand Prix winner in the past, and this year was number 8 in Europe. China, for the last few years, has not seen financial services companies at the top of the rankings. That's in contrast to several years ago when China Merchants, Ping An Insurance, property developer China Vanke, in real estate anyway, they were the gold standards in IR across the region. But today we see telecoms really coming in at the top more, China Telecom and TSMC from Taiwan, and they're looking at the whole region. But two other areas from the report to highlight, just as an introduction. Over the past year, we talked to IROs from American Express and Allianz and J.P. Morgan and others to get a feel for the kinds of questions they field from investors and the kind of tone and message that they're putting across. And it will not come as in any surprise that interest rate sensitivity has been front of mind, but other issues, regulation, the actions of central banks, in the past few years, cost-cutting of great concern as well. Now, lastly, investor relations officers at banks may take this for granted, but IROs outside the sector may well wonder about the question of any sell-side conflict of interest. I mean, what happens when a sell-side analyst looks at a rival bank? That's something covered in our report. Now, the question has got to be, is IR for financials different from other sectors? Looking at the sheer numbers and the averages across all regions and market caps, the short answer is no. And here you can see IR department budget, staff, number of meetings, days senior management goes to IR, analyst coverage, the number of roadshows, pretty much the same for financials compared to other sectors. A slight shortfall in budgets, perhaps about 10%. One possible explanation I can think of is that IROs at banks and the like have more help with competitive intelligence and reporting from other departments within their firms than, say, IROs at manufacturing companies. Now, one area of comparison that's worth looking at, because the report does break down the data for different regions, different market caps, a lot of the times financials track very closely with other sectors in other regions once you start breaking it down. But one region where they don't, Europe. When we look at financials here, they spend a lot more time on IR than their counterparts in other regions, it appears. The IR teams are bigger, they have more analyst coverage, and do more road shows. And compared to other sectors within Europe, both analyst coverage and the number of road shows are slightly higher for financials than other sectors. And budget and team sizes are 20% higher. So here's a look now at the financials that made it to the IR Magazine Global Top 50 for 2015. This is a ranking that combines all our regional rankings from the past year. This is alphabetical. It doesn't include real estate companies like Capital Land in Asia that really excel in Asia. But when we're looking for models for best practice, here is a great list to start with. Obviously, some household names there. JP Morgan Chase, American Express, at the top of our financials in the U.S., for example. And interestingly, the top two in Europe are both insurers, Allianz and Munich Re. And in Canada, TD Bank has been number one overall across all sectors since 2012. Intact Financial, an insurer, has been rising in the rankings there, getting to second place for financials in 2015. In Greater China, the sector leader is Hong Kong-based Bank of East Asia, not too well known outside the region, about US $9 billion in market cap. Southeast Asia, DBS from Singapore, not only top in its sector, but also number one in Southeast Asia overall. Thailand's Kasikorn Bank has really been coming along strong in recent years, runner-up in the sector, fourth in Southeast Asia overall, and won the award for Best IR by a CEO in 2014. Now, what makes these companies stand out, and just before going to Allison, for a look at the sector more broadly, I want to give you a little bit of color about a few of these companies. And this is according to the analysts and investors in our award survey. There's a lot more of this contained in our regional investor perception studies, but let me just give you a little bit of a feel. Allianz is a good example and could be well be said for a lot of the companies. The head of IR there, Oliver Schmidt, he stands out, according to analysts and investors, for his knowledge, his experience, and his closeness to management. Plus the whole team, that's about 4 other IR officers, are praised for their knowledge of the company. In the U.S., JP Morgan Chase really setting the standard, 11 in the department. Now that's obviously, that's one of the largest IR teams of any kind that I know of in the U.S. Sarah Youngwood heading it up for the past 18 years. Also won the award, JP Morgan won the award for Best Financial Reporting. And the IR team is justifiably proud of its quantity and quality. Also strong CSR report there. Discover Financial Services is worth highlighting in the U.S. It's been a big improvement there. Here's a quote from Buy-Sider. Big improvement in Discover's meetings, both in breadth and depth and in identifying key issues. And another Buy-Side respondent in our survey said that over the past couple of years, the IRO has done a great job of delivering Discover as a much more visible company. So the IRO there, Bill Franklin, really doing a superb job. A few other companies I could tell you in the U.S. also stand out. The Hartford, BlackRock, MetLife, some big banks besides JP Morgan, Citigroup, Bank of America, Wells Fargo, all rank highly in our survey. Quick mention of Asia, DBS, and K-Bank. DBS stands out, clear reporting, including segmented reporting, a good website. Very tight team there, just 2 executives plus support, headed up by Michael Sia, but strong involvement from management, including divisional heads, and strong in governance and sustainability there as well in the region, for the region as a whole. One of the first companies in the world, in fact, to do integrated reporting. So, as I said, much more about K-Bank from Thailand, or Canada's TD Bank, Itaú Unibanco from Brazil, all in our regional investor perception studies. Okay, Allison, let's go to you now and get your perspective as an analyst. You're senior analyst for financials with Bloomberg Intelligence, again, with specialization in global investment banks, asset managers, as well as North American banks and specialty finance. So let's go give us your perspective as an analyst on IR in the financial sector.
Thanks. So I think that investor relations in the financial sector is always a role that's challenging, and that's given the complexity of some of the firms, and then you have the added challenge of navigating the macroeconomic as well as legal and regulatory issues, and helping investors and analysts understand the impact to the companies. During the financial crisis and in the years since, the effort has had to further evolve as these challenges have become more intense. And I think one of the great things that's been done across all of the big banks is to provide more disclosure and to keep that disclosure very dynamic. So, we all complain about the thousands of pages that we have to go through every quarter, but, quite frankly, I think investors and analysts would miss those thousands of pages if we didn't have it, because it really is an effort to try to better understand what's going on in the bank. And I think the industry's been dynamic in the sense that when new risks evolve, they'll provide those disclosures, and they'll provide them, for as long as they sort of stay a focus of investors. So, for example, the GIPS, when we had all the issues with Greece, Ireland, Italy, Portugal, and Spain a few years ago, when those were really driving the stocks and driving the bonds, companies sort of every quarter provided more and more disclosure. More recently, there's been disclosures around foreign exchange and how that impacts people's balance sheets, especially from the Swiss companies. And so sometimes these slides come and go from investor presentations, and then there are other things like interest rate sensitivity that are sort of a staple and that investors will continually look for in the 10-Qs. One of the other interesting developments within financial services relates to a sponsored accounting task force by the FSB, who is a regulatory, it's basically a global bank regulatory body, and they sponsored this task force called the Enhanced Disclosure Task Force. So made up of different bank stakeholders. They put together 32 different recommendations, and the slide in front of you shows you the implementation of those recommendations by participating banks. And if you wanted to get more information on this task force or exactly who the banks are, this report's available on the terminal under the FSB ticker on the regulator's website. But it is sort of the largest global banks around the world, including people like Citigroup, Bank of America, RBS, Barclays, HSBC, etc. And I think this will be becoming a broader issue, just with things like the SASB, which is focusing more on social recommendations and such. So I think it's something that helps in terms of what disclosures can be provided. And as I said, the financial industry has been a little unique in terms of the crisis and investors wanting a lot more related to risk, and the effort really moving to answer that. So the next, and I guess I'll just throw out one more example with regard to J.P. Morgan, who was mentioned as one of the leading firms. Sort of another example of dynamicism is, or being dynamic, is their response to the London whale incident. So the company normally has these hour-long conference calls. When this issue arose with the trading losses in the CIO unit, the calls went to 2 hours, and really just making themselves available to answer the questions on analysts' and investors' mind. So we go to the next slide in terms of things to come. Unbundling is something that our regulatory regulatory team is watching in Europe, which could have potential global consequences. And as you can see from this slide, which basically breaks out sort of what the buy side values the sell side for, you can see the slice that relates to corporate access, but you can also see the slice that relates to analyst meetings. And there's questions around, what the ultimate impact of unbundling could be. So basically, if there is a separation between the paying for trades and the paying for research, does that ultimately drive a wider proliferation of analysts, or does it sort of narrow the group because there's less money to pay? And that obviously has implications for investor relations, because you could have to try to spread your effort out to a wider number of analysts, or you might have a more focused analyst on the sell side. And then in terms of the next slide, which is sort of a busy chart, but we're basically showing the credit curve for A- rated banks. And you can see that the banks on the debt side trade fairly tightly together. So in terms of the financial services investor relations across these big banks, what has happened over the last few years is that there's been a lot of growth in the fixed income investor effort. And I guess one of the interesting notes with regard to Citigroup, who is rather unique in the fact that they have a quarterly conference call for fixed income investors, and their debt actually trades much closer to its peers than the equity. The equity trades below book value, which is a significantly lower valuation than its peers. So obviously there can be a number of reasons for this, but fixed income investors really do feel like they get a lot more information from these calls. And other companies like RBS and Barclays as well, that have had a lot of government ownership of the equities, have also really enhanced the fixed income effort. So on the next slide, in terms of tracking peers and peer disclosures, so obviously it's helpful for investor relations folks to have a place and process to track what's happening at the different peers. Here in Bloomberg, the tool that we have is we have BI, which is my product, and this is a screenshot of different interest rate disclosures across banks. So it's not a specific investor relations tool, but because the interest rate disclosures vary for different banks, this can be a handy way to kind of click in and see how the disclosures differ, because everything within Bloomberg, if you were on the terminal, you could click in and that will take you to the ultimate document. So it's a good way. You can track things like disclosures. You can just track operating trends. So obviously it's important to have a process to do that. I'm sure everyone has their own process. This is the process that we have at Bloomberg. And then finally, obviously monitoring the holders of your stock is important, and important to have sort of a process in place to do that. Another thing that can be helpful is to monitor what other stocks your shareholders might hold. So again, you might have your own tool to do this. At Bloomberg, we have the holders function. You can see here, if I was investor relations at JP Morgan, I can easily see who owns my stock and what other peers they might own. Also, who owns the peers and doesn't own my stock. So it can be an interesting way to track who, potential holders. And I guess I will just leave it there.
Allison, thank you. Excellent overview. I love the way you put it. The banks, the financials as a whole, are dynamic in their IR. They're being flexible, adjusting to whatever the forces in the market are that need commenting on, whether it's interest rates or new sustainability and risk issues. So this is, and I guess in that sense, it does provide lessons to other sectors as well. We're very happy to take questions from our audience. You can type them in on the webinar platform. We have one right off the bat. Allison, I'd like to read to you. The question says, does the buy side recognize the extent to which the regulatory and ROE pressures on the global banks is opening up competition in investment banking and trading to smaller, more specialized competitors?
I think that that is something that the buy side is very focused on, and I think if you look at a lot of the questions as we on the second quarter calls, I think we're going to get those questions again on this quarter. There's always a long-term focus in terms of how are you going to get your returns up and how you're going to grow your cost of capital to the specific banks, which has turned more towards cost conversations as there's been revenue pressures. But then there's also questions about what is going on with the competitive landscape, and one of the bigger themes has been some of the European banks, which are still sort of in the process of figuring out, I guess, who they want to be. So you have people like Credit Suisse and Deutsche Bank, which are due to announce major strategy changes. And so a lot of the questions have revolved around, what are banks seeing in terms of pricing and the economics of the firm, economics of different businesses, and sort of where are you seeing pricing differences, as that's obviously an indicator of competition.
Okay. Here's another question that we received from the audience, and that is, and it's kind of related in a sense, and that is, with all the volatility in the global markets right now, are we starting to see a flight to quality, or are institutional investors largely taking a wait-and-see approach?
So I think it probably depends on the investor that you speak to. I think in general for financial analysts, the markets can be tough when they're very macro-driven, just because it tends to, the stocks trade together, and obviously the way investors try to make money is on stock selection. And so I think, for investors in a market where there is a lot of volatility, they just try to buckle down and just, it's almost more of a behavioral investing phenomenon in terms of just trying to block out the volatility and just focus on the fundamentals of the stock. So, for example, in the most recent sell-off, it's all about rates. You can see, especially with the regional banks, the way that they've traded. Rates as measured by the long term, which is really just a proxy for, I think, expectations. But rates go down, the stocks go down. And so I think what investors try to do is to say, if this environment continues, who has the protection? And that's why you get all the questions on cost cuts. That's why you're getting more of a focus on fee income. So hopefully I answered that question.
Okay, so some of those issues like the cost cutting, I want to interject a question of my own here. So issues like cost cutting, kind of perennial interest rates certainly been extending over a matter of years. There's concern around that. I understand right now one of the hottest topics is extending credit to energy companies, right, and the quality of assets as a result of the fall in oil prices. Are you getting more information on that this quarter?
So I think, and again, as I said, this goes to sort of the dynamic nature. We started getting more information, probably for a couple of quarters now, where companies have, given more slides. And for example, Citigroup gives a very detailed slide of exactly, investors want to know not just how much of your portfolio is energy, but what types of energy companies, what are the ratings, what are the credits, and so I think investor relations can be helpful in a couple of ways. One, they can just, so Citigroup Investor Relations will provide the slide that basically says, look, if you think about the type of lending that we do there, it's large multinationals. It maps out the portfolio, and that's very highly credit weighted. And then, you have someone like Wells who also helps to frame the debate for people by making the point that if you look at, yes, energy is a risk that they have, but the size of it, it's 2% of their portfolio versus mortgage, which is something like 40%.
Okay, good. Thanks, Allison. Thinking again about the way different companies address some of these issues, could you expand a little bit on interest rate sensitivities and what are the different types of disclosures or models that you get from companies on that issue?
So I think, and in fact, one of the slides that we used, the example for BI, sort of maps out some of the interest rate disclosures, and it definitely does vary bank by bank in terms of the way they do their calculations and the assumptions that they're included. But I think, again, the more information is better. So you have someone like Citigroup that tells you not only what the impact is on revenue, but what is the impact to their capital ratio, because there are different impacts. And so while most banks will focus on, here's the upside or downside to our revenue based on this scenario or that scenario, there's other disclosures that are helpful, and UBS is another company that talks about what the impact is on their capital ratio.
Okay, good. Here's another question from the audience, and it's a basic question, but it has as simple or as complicated an answer as you want. And that's, which information is the most important for you concerning financial statements?
That is a tough one, and it varies over time, right? So as I said, there are some certain slides that are very interesting at different points in time, and there's certain times when it's not interesting. Energy is becoming more interesting. 5 years ago, people probably didn't care about it as much. I think for the financial companies, some of the first things I turn to, the first thing that people, I think, turn to is basically what happened with trading, just because it tends to be very volatile and all over the map. So that on a quarter-to-quarter basis, I guess people think is pretty exciting. But I think, if you're looking at long-term and what is the most important information to sort of judge what's going on in the business, I think what's really helpful that the big financial companies do is to give you, here's how we allocate equity across the different businesses, and here's the returns on the different businesses. And so you can see sort of where the strengths are over time and where the weaknesses might be. So I think that's been very helpful.
Good. Okay. And maybe you could comment on the issue of capital return. So this is becoming an issue across lots of sectors, and it looks like it might be an election issue in the U.S. with buybacks put into question. What are some of the issues or questions around the financial sector in that area?
So I think in terms of capital return, and one of the reasons why it becomes such an issue is that you had banks, sort of building up all this capital, especially in the more stressful environment. You had companies not paying cutting their dividends and stopping buybacks, and so that's sort of been a longer term themes in terms of first returning kind of maybe the bulk of things that were built up to protect during that crisis, and then on an ongoing basis. I think capital return is always a big story for financials. And so, companies differ. Here in the U.S., we have the stress test. So after the stress test, people communicate their dividend increases and buyback. Most banks do. So that's helpful. It's not as helpful when banks just say our plan was approved and you'll see what happens from here. Because obviously, as I said, more information is better. So it's great to know, what is the buyback that you plan to pay out? Is that net of repurchases, et cetera? And then what's helpful for, I think, investors is, to get guidance on, the two factors that really go into that equation. So one, what are your returns on equity that you're generating, and what can you tell me to give me some level of confidence that you'll be able to generate those returns? And then secondly, what are your targets for your capital ratio, and how will you get there? Part of it will be improving returns, and then part of it will just be, could be selling off assets, which would obviously require you to hold less capital.
Very good summing up, and obviously capital return a bit more complex for this sector than perhaps others. But at the same time, maybe more information, more disclosure around it. Well, Allison Williams, Senior Analyst for Financials with Bloomberg Intelligence, thank you so much for a lot of really good insight. It's been very interesting. And thank you to Bloomberg also for being our partner in this webinar. Look for more sectors covered in future webinars. So right now, I'm Neil Stewart for IR Magazine. Thank you very much.